So picture this, it's 1998, and a hedge fund run by literally the smartest guys in the room, we're talking 2 Nobel Prize winners, loses almost $5 billion in just 4 months. And they didn't just fail, they came so close to bringing down the entire global financial system. The story you think you know about why that happened? Well, that's not the real lesson here.
Yeah, $4.6 billion. It's just a mind-boggling number. But you know what's even crazier? This loss came from a team that was basically seen as the financial world's dream team. This wasn't a story about people being incompetent. Oh no, this was a story of supreme, world-class confidence hitting a brick wall at 1,000 miles an hour.
And that really gets us to the heart of the matter, doesn't it? It's the big question that people have been kicking around for decades. How on earth did a team with this much brain power make a mistake of this size? Well, the answer is a lot more complicated, and honestly, way more interesting than you'd think.
To really find the answer, we've got to look past the usual headlines about LTCM. We need to do what's called a structural diagnosis. Basically, figure out what went wrong from the inside out.
Okay, so the story you usually hear about the LTCM collapse is pretty simple. The story goes, they borrowed way too much money, and then this totally unpredictable black swan event, the Russian financial crisis, just showed up out of nowhere and completely wiped them out. And look, that's not exactly wrong, but it's not the real lesson, not even close.
Right. As our source material puts it, that explanation is just, well, it's too shallow to actually be useful. See, it kind of lets us all off the hook. It lets us just say, oh, well, that was just a freak event. It's not going to happen to me. But the real failure was way deeper. It was built right into the structure of how they thought.
LTCM's whole game was built on something called convergence trading. And on paper, it's actually brilliant. You find 2 things that are really similar, say 2 government bonds, that are just temporarily mispriced compared to each other, and you bet that over time, their prices are going to snap back to their normal relationship. Statistically speaking, this was a sound, almost boringly reliable way to make money.
And right here, this is where we find the first huge flaw in their thinking. What they built, it wasn't a strategy. It was one single, massive, and incredibly fragile debt. And that difference? Well, it's everything.
You see, every single one of their trades, no matter how different they all looked on the surface, all depended on one single core belief, that markets would stay pretty calm, and that they could always buy or sell whenever they needed to. Their whole world was calibrated for just this one reality. And this quote just nails it. A real strategy is tough, it's resilient, it can adapt when things change. A bet, on the other hand, only works if the world does exactly what you expect it to. LTCM wasn't preparing for the future, they were predicting it, and they bet the entire farm on being right.
Now, this leads us straight into the second big structural failure, what we can call the optionality trap. And this is all about having flexibility, or in their case, a catastrophic lack of it.
This slide just lays it out perfectly. On the left side, you see the good times. In calm markets, their insane leverage was like a superpower. It just amplified all their returns. And optionality, the ability to pivot or change your mind, that seemed like a total waste of money. But then, look at the right side. When the crisis hit, that same leverage that was their superpower became a straitjacket. It completely destroyed their ability to move. And that optionality they'd sold off for basically nothing, suddenly it was priceless. And they had none.
Okay, so that brings us to the third big failure. And this one is one of the sneakiest and most dangerous traps out there. The illusion of safety. The idea of fake diversification.
I mean, if you just glanced at LTCM's portfolio, it looked rock solid. We're talking hundreds of different positions in markets all over the world, across all kinds of different assets. On any normal day, in a normal market, these things all moved independently. They looked, for all the world, uncorrelated.
But here's the punchline. When that Russian crisis sparked a global panic, everything changed. In that mad dash for safety, all of those supposedly separate positions started moving together in lockstep, and they were all moving against LTCM. Their diversification, it was a mirage, a ghost that disappeared right when they needed it the most.
The fourth failure was all about their funding. They were borrowing money on a really short-term basis, sometimes having to get new loans every single day to pay for investments that were tied up for the long haul. This is a classic recipe for disaster known as a maturity mismatch. It works fine, as long as the people lending you money every day stay happy. And this is such a key distinction to make. Volatility is just when prices jump around. You can survive that. But fragility, that's a deep structural weakness, a crack in the foundation that just shatters under pressure. LTCM had spent years of calm markets building immense fragility into their system. And when the shock finally came, the whole structure just couldn't take it. Their lenders got spooked, they pulled their funding, and that's what started the death spiral.
So when you put all of these pieces together, the single bet on reality, selling off all their optionality, the fake diversification, and that fragile funding, we finally get to the real diagnosis of what happened.
And this is the most crucial point of all. LTCM did not fail because their math was wrong. Their math was beautiful, it was elegant. No, it failed because their entire complex system was perfectly tuned for a version of the world that, in the fall of 1998, just stopped existing. They weren't being irrational, they were just fatally unprepared for reality to change the rules.
And this, right here, is the core lesson of this entire saga. You can have all the intelligence in the world, but if your strategy isn't structurally sound, if it isn't aligned with the fact that different realities are possible, then all that intelligence is just going to create a system that is incredibly brittle.
Now, the way we've just walked through this diagnosis, it's actually based on a really powerful framework called strategic calibration mode. And it's designed to do exactly this, to find these hidden weaknesses before they turn into a catastrophe.
So what does all this mean for us, in our own lives and work? It means we have to start asking much harder questions. Don't just ask if a decision makes sense today. Ask what happens if the world is completely different tomorrow. What happens if the money dries up? What happens if all your safe bets suddenly move against you at once? These aren't negative questions. They are absolutely essential for building something that can actually last.
So I'll just leave you with this final thought. Take a look at your own projects, your business, your investments, and ask this one simple but kind of terrifying question. Find that one single assumption that's holding it all together, and then ask yourself, what happens if it breaks? Because the ultimate lesson from LTCM is that even being a genius is no defense when reality decides it's time to change the game.